Good afternoon, everyone. This is Professor Milligan, and welcome to Wall Street Wednesday. All right, I'm going to give a few minutes, as I always do, to allow people time to log in. Pretty interesting day in the marketplace, so I'm just chit-chatting a little bit here. I know we closed. Volatility was in the market today, up, down, rotation. Moving out of some of the tech stocks. It looked like they were moving into basic energy or basic materials, energy stocks. But we'll talk about that and some other things. And I'm really excited to finish our conversation, or not finish, but continue our conversation on IPO stock and how to make that money. Again, welcome everybody. Thanks for joining. There's my soup. I see my soup's on here. Some other people. So And again, give me a few minutes. I'm just going to chit-chat a little bit. Looks like the market's going to close up 60 points. 60 points after being down 244 points a day, after being down all this week. But I'm going to get into that in some detail. And the reason being is I don't think it's, how can I put this? I don't think it's a sell-off. In fact, I think what's happening right now is pretty healthy for the market. And I'll explain what I mean by that. So let me start there. What do I think that what's happening right now is healthy for the market? Anybody that's been trading or investing in stocks for an extended period of time knows that one of the things that happens is stocks don't go straight up. They don't go straight up. They don't go straight down. Now, we've had a major move. In fact, I'm looking at the chart on the S&P 500. I'm looking at a chart, and I'm pretty sure, I'm not sure where we closed at, but I'm pretty sure that the S&P 500, I'm just looking, it looks like Snowflake, I'm not sure the earnings, it looks like Snowflake took a hit on the close. I'll take a look at that in a second. But it looks like the S&P 500 closed at a record high. Looks like NASDAQ also pushed to a record high. So what I think you're seeing right now is what I call backing and filling. The market doesn't go straight up. It's going back and filling. You have some people out there that are taking profits and trying to lock that in. So they're trading the market, but in terms of the stocks, but the market's held up and it's bounced back and it's rallied back. Now, you'll hear conversation out there that one of the things that's moving the market back up is that there's conversation about the stimulus package and that can be coming forward. I don't know. I do know that it's a good thing for the most Americans. So hopefully that they do work that out. The market looked like it was pricing that in there, or it looks like the market's trying to price it in there. But again, anytime you have the kind of run that we've basically just had, you expect some backing and filling. So that's where we're at. I'm looking at my portfolio, and for the last 2 days, I'm down about 10% of my portfolio. A lot of the stocks I've traded, in terms of IPOs are basically back at their support level, back at pretty much where I purchased them at. I'm okay with that. And my long-term stuff that's been actually trading really well has come down and is trying to form a near-term support. So I guess what I'm saying to you guys is do not panic. All right, it's not time to panic. The other thing that I did today was I went and took a look at the VIX, which I always do. And the VIX had a little bounce today, but the VIX pretty much is flat. And the VIX is trading now down near the lower end of the Bollinger Band, which means that long-term we are looking for a correction. But as we always talked about, this could also be something that can continue for a while. So VIX running on the lower Bollinger Band set for 2 standard deviations is not scary. All right, let's see what this is. Buffett indicator suggests that we are getting into a market that's overvalued. What are your thoughts? Well, when it comes to growth stocks, in most cases, I always think they're overvalued. Especially with Warren Buffett. Warren Buffett, as you guys know, is a value player. A lot of stocks have made tremendous runs. And I think that is as far as the way I invest, the way I look at it is, as long as my stocks are going up or momentum's with them, I'm just going to stay with them. I did expect, which I always talk to you guys about, I do expect the retracement, which we're getting. I think that's healthy. The thing that you also have to consider is this. As much as investors might think the market's overvalued, the one thing that always holds true is what's going on in terms of buying. Now, it's really interesting because the market's overvalued, but at the same time, we're at record highs and volume seems to be there. So I wouldn't I wouldn't panic yet, and I wouldn't hit the short button on anything because, again, you could be short squeezed out. And again, I'm just looking at the market. I do have some indicators. Most of my indicators are basically saying the market is basically in an upward trend and this consolidation. And the thing that you can look at right now is look at this rotation. You have stocks that are pulling money out. And I think part of that was because of what happened with Zoom this past week. You know, Zoom beat on revenue, Zoom beat on the earnings, Zoom raised their forecast, business is great. I mean, I think if I remember correctly, again, don't quote me, I think Zoom even said that their numbers could be quadruple of what they were a year ago or 2 years ago. So Zoom is really just pushing the number. And with all that, Zoom sold off. When you see that kind of thing happen, they beat the number. The stock started to sell off in the aftermarket, which means investors basically were just getting out and taking their profits. Then what happens is most investors are like me. And what I mean by that is, if you're a momentum investor adds to their position as it goes up, Each time they add to the position, they put a stop right below that new position. So they add, stop. As long as the stock's going up. So what happens is when the stock starts to come back down, they start triggering all these stop loss orders. Or the trader themselves start to sell it. And that can lead to momentum in terms of downside. You're seeing that in Zoom. You're seeing it in a couple other tech stocks. Nothing's fundamentally changed. All right. The other thing is you're hearing some people say that because of the pandemic, looks like it's coming to an end, hopefully by June, I'm hearing June 2021, that we could be back to normal because of the vaccines. They're projecting now that the companies like the Zooms, the Pelotons, the stay-at-home businesses won't be doing as well, and they're starting to lower their numbers. That's what people are thinking. I disagree with that. Again, I'm a momentum trader when it comes to trading. And with that said, I do not buy stocks as they come down to the bottom of their trading range. I look for it. I expect it. I have it all plotted out of where I think the stock's going to go in terms of the downside when it does correct. And one of the things I got to check on is Snowflake. Snowflake right now is at 270. Now, the reason why that bothers me is support level for me on Snowflake was 300, 290 in that range, the old high. So I've got to go take a look at this. I might be closing out my position in Snowflake. I was basically at my cost level, so I'll have to check it out. All right, now, couple of things I want to, so that's the market. That's my opinion. I don't see any reason right now to panic. I don't see any reason to close out my positions. I like everything I own. The only one now that's actually below my cost right now in terms of the stocks I trade is Snowflake, so I'll have to take a look at that. And talking about Snowflake leads me into what I want to get into today. We've been talking about IPO stock and what to do with them once they hit the secondary market. Hot IPOs, flat IPOs, cold. Today, what I did was I pulled up, and I'm going to pull up now, a couple of cold IPOs. And they might not start out cold, but they end up being cold. So let me pull up, which one am I pulling up? Let's see if this is the one. All right. So one of the things that you're looking at right now, this is ADT. So let me go to ADT's chart real quick. Bear with me a second. I believe this is ADT's chart. Nope, that's LYFT. Uber. Geez, of course, there it is, ADT. Now, in order to get all this chart data here so you could see it, I was forced to go to a monthly chart. So let me give you some information here. ADT originally filed look at the chart, but let me go back here so you can see what I'm talking about. ADT originally filed to go public on December 2017. All right, now here's where the numbers start getting interesting. Get my dates right. Sorry about that. On January 5th, that S1A filing you see on January 5th is when ADT came forward and said, okay, we're going to go public. We're going to actually issue 111 million shares to the public, and the price range was $17 to $19 a share. On the S1, on the 18th, it went public on the 22nd. When they went public on the 22nd, they actually priced the deal 105 million shares at $14. So what they did was, and the reason why I put this up here, you can actually find this. What they did was, understand this. The institutional investors put in an indication of interest on what they wanted to pay for the stock. So when originally they filed the $17, $19 range is when ADT decided what they wanted to do and how much they thought the company was worth. Subsequently, ADT started doing what we call a roadshow, dog and pony show roadshow, where senior management travels around the country and starts pounding the table, talking to institutional investors and telling them all the reasons why they should own their stock and how come they're going to make money. Well, the institution put in their indications of interest, which is telling the investment bankers how much they were willing to pay for the stock. The investment bankers had to lower the number of shares, and they lowered the price to $14. What that tells you is that the institutions thought the stock was overvalued at that level and really didn't have much interest in it. Again, the deal was priced on the 22nd at $14 a share. I'm going to the chart right now. And as you can see right there, the stock opened up below its IPO price at 14. Now, anyone here will tell you, for me, anytime an IPO stock, especially one with ADT's name, opens up below its syndicate bid, its offering price, which was $14, it is a short. Now, you're looking at a monthly chart because I want to make sure you can see all this. So you have a monthly chart here. The stock sold off. There was a little bounce a couple of months ago, but you can see that after that, it went right back, and right now it's at $8 a share. You might not have been able to find stock to short, but what you could find is you could actually, at some point, the stock did have some options, and eventually there was stock to short. This thing was in trouble, and it's still in trouble. Now, the other company that I put up here, another one that fits the same bill. Let me go find it. Let's see. What you're looking at, and I apologize, you have this, is Casper Sleep, the mattress company. Let me give you some information here on Casper Sleep. All right, so here's the deal on Casper Sleep. They filed the offering, and when they filed the offering, they said they were going to do, on the S1, they finally put the price out, they said they're going to do 18.3 million shares, and the price range is going to be $17 to $19 a share. About 2 weeks later, on February 5th, they then said they lowered the price range to $12.13. Now, I need to stop here for a minute. Make sure you understand what's going on. When these investment bankers bring this IPO, when they actually file the S1, they file to go public. Right after that, the investment bankers and the senior management start to do their roadshow. They start soliciting business from institutional investors. And they tell them how good the company is, what the prospects are. And these institutional investors actually put a valuation on it. So my finance students will tell you, one of the things that we do is we put a valuation on it. We go through and crunch some numbers and say what we think the stock is worth. This is what the institutions do. So when they finally started saying what they would pay for the stock, Casper went down from $17.19. They kept the offering size the same, but they lowered the price to $12 to $13. The company went public on February 7th at $12 a share. And I'm looking for Casper. I believe that's Casper Sleep right here. And again, I'm showing you the chart. And as you can see right now, Casper Sleep never, ever, ever traded above $14 a share. It opened up and went straight down. And from there, it's been nothing but go straight down. Again, when you see this breakdown, you can actually see these things and get short. Now, I see a question here. It means that the value was not worth the offering, right? No, what I'm saying to you is this, that institutional investors are price makers. You and I are price takers. Whatever they decide the price is at, we take it, and either we say we want the stock or we don't want the stock on the IPO. Institutional investors, they actually will crunch the number, and they'll tell the investment banker, all right, I want to own 1 million, 5 million, 10 million shares, and they'll tell them what price they're willing to pay for it. This is called building a book. All right, and I just saw it. Snowflake missed on the earnings, but beat on revenue. So that's why the stock sold off. Interesting. All right, so anyway, Institutions are price makers. They tell what they're willing to pay. Once the book is built, the investment bankers will then say, okay, based upon where we see the book and where we see institutional investors want to pay for the stock is where we price it. Now, these institutions, once they price it, these institutions basically probably pretty much did not have any what we call aftermarket buying. And that's the reason why you see the stock break down. So here's what I'm telling you. One of the ways you can find out if the stock is going to go higher or go lower is to go into NASDAQ.com's website, go to the IPOs, and go to the filings. Oh, it's hard to see that one, so I'll put this one up. And go to the filings. And then I literally click on each filing and see what they're doing with the price. Anytime there's a change, whether it be price raised, price lowered, shares increased, shares decreased, they have to issue a new S1A. And it's public information. They have to give it to us. And people like you and me, what we do is we take that information, we read it, and we make decisions on it. All right. Those were two IPOs that from the day that they were priced, we knew they were in trouble. Now, the other ones I want to show you, and I'll pull it up right now real quick. See if I can find it. Let's switch that out. Let's talk about LYFT. All right. I believe, if I remember correctly, LYFT went public before Uber. So here's the deal with LYFT. Now, this is interesting. LYFT filed their original S1A, their first S1A, and they said they're going to issue 30 million shares at a price range between $62 and $68 a share. Then what they did after that, they came back, as you can see, on the 27th, March 27th, and they raised the offering price. They kept the 30 million shares, but they raised the offering price to $70 to $72 a share. After that, LYFT priced the deal, and they increased the size, 32 million shares at $72 a share. Now, for you and I, when I see those type of numbers, I'm thinking this is a hot IPO. We knew the name, we knew what was going on, but let me show you what happened here. LYFT opened up at 72, and by the way, let me go to my bigger chart over here so I can make sure I give you the correct information. LYFT was priced at $72 a share. I'm on a daily chart now, so I can really get to the numbers for you. LYFT was priced at $72 a share. The first day, the stock opened up at $87.50, right around there. Closed at about $79 a share. And then by the second day of trading, the stock broke its IPO price, $72 a share. Now, the thing you got to understand, and let me switch out of this so you can see me. You have the charts. The thing you got to understand is this. The $72 price is where the investment bankers make their stand. Part of the agreement the investment bankers have with the corporation when they bring them public is that they will support the stock at the issue bid price. All right? They're going to hold it up. They're going to hold it up there, and hopefully investors will take over it and hold the stock up. But the investment banker's job is to make an orderly market, and they're going to sit there what we call the syndicate bid, which is typically the offering price. So they sat there at 72, they tried to hold it up, and it broke down. It rallied after that, and then eventually the stock broke down. As you can see from there, LYFT broke it after after the third week, it broke that 72 hard. It broke it after the second day, but then it broke again hard. And from there, the stock went down as low as $20 a share. All right, couple things going on here. And let me take this chart off. Couple things going on here. One, why'd the stock run? Easy. People bid it up. You and I, not me, but people out there in the community, oh, LYFT, great company, this and that. I use the service. I got to own the stock. So they immediately jumped on it. That type of hype and demand pushed the stock up. The company could not maintain the hype that was behind it. When the financials finally came out, people like me went through and crunched numbers. We said, whoa, look at the debt. Look at the risk. This company's not worth that. And that's the reason why the stock broke down. Now, right after LYFT went public, right behind it 2 months later, and again, I'm trying to find it, bear with me. I think that's it. Is that it? No. Then this must be it. Uber went public. And again, with Uber, now here's what's interesting with Uber. Uber filed the S1, they originally filed, and then on S1A, when they put the price in, they said they're going to raise 180, they're going to issue, 180 million shares at a price range between $40 and $50 a share. They followed that up and actually brought the company public basically 2 weeks later. And 2 weeks later, they priced the deal, 180 million shares at 45 in the middle of the range. Again, company could not live up to the hype. Let me find that chart. And there you see it. Now, what's interesting with Uber is this. Uber was priced at 45 and it did not see 45 I take that back. It was priced at 45. I'm pulling up the daily chart right now. Make sure I give you guys accurate numbers. I don't know what it is, but I just got to make sure the numbers are accurate. So Uber was priced at 45. The first day of trading, the stock went to, opened up at 45. Opened up at 42, went as high as 45. And then that same day closed down, the next day closed down as low as $37 a share. Now to stay with Uber actually eventually at some point did break the 45. But then if you look at the chart closely, several months later, it broke that 45. These offering price numbers are key numbers. They really are. A lot of institutions, a lot of investors, when it breaks that syndicate bid price, even if it's a month or 2 months later, it's not going to hold up. And that stock turned out to be a huge short. And again, it went from 45. When it finally broke down, it broke from 45 and ran down to $26 a share. These are when IPOs turn cold. These IPOs were up because of the hype from investors ahead of the deal. And you guys kind of know it. Just like everyone's saying, I can't wait for, who's the other one now? I can't wait for Airbnb. I can't wait for this one. I'm here to tell you something, you guys. Be very leery of Airbnb. Be very leery of DoorDash. And what I mean by that is there could be so much hype in the marketplace for these two companies that they could drive the stock price up like we saw in Uber and Lyft. And fundamentally, they're not there. They can't hold that price level. So they could have a sell-off. The scary part about it is the more they rally up on the opening, the more they're probably going to be a short. Now, somebody's saying, I feel like Airbnb is about to be this now that I'm learning this. Yeah, I mean, again, all I'm saying to you is what's that Public Enemy song, Don't Believe the Hype? Well, there's a lot of hype behind this. But again, when these financials come out, it's going to be interesting. So I've seen more hot IPOs trade like Airbnb, but like Uber and Lyft in that respect, in terms of that there's so much hype, they run up ahead of the release, and they run up on the release of the IPO, and they can't maintain it. So I love the question. Here's the answer. Should I invest and then short? The short answer is this, which you weren't here for last week. So I'm not, again, if the IPO breaks the syndicate bid, the first day, second day, the first week, get short. All right. If the IPO, let me say it again, if the IPO breaks its syndicate bid the first day, the first 2 or 3 days, it's a short. The only challenge you're going to have is, can you find stock too short? The other thing that guys know is I'm not a big proponent on buying IPOs the first, second, third day. I want to give them time to see how they're going to react and then go from there. So Airbnb, one, I would not get long the stock on the opening of the first day. I can't tell you how many times I've had to calm investors down and say to them, look, do not short buy the stock on the opening the first day. Wait and see. Now, I'm going to say something to you, and hopefully this makes sense to you guys, and that's this. If you believe a stock, a $20 stock, is on its way to $50, $60 a share, $100 a share, buying it at $20 a share or buying it at $30 a share is not going to make a big difference in your portfolio. Is that making sense? Now, if you're out there day trading or short-term trading for a point or 2 points, then that $25 or $20 price is going to make a big difference. But if you're out here, again, this is me, and give you a prime example. Palter, Palter, I kept calling it Planter, it's Palter, PLTR. Brought the stock, it went up to almost $30 a share. I was up 100%. It's back down to $22 a share, I think it is where it's at now. In fact, I'm looking at it, closed at $22.41. I'm still there. Big moves take time. What happens when these stocks make these kind of runs, sometimes you'll have short-term investors, short-term traders who basically get in, get out, and taking their money and go. I got no problem with that. Big moves take time. Is that guaranteed that Palantir, see I did it then, is going to go to $100 a share? The answer is no. But I do know this. The only way I'm going to find out if it's going to go to $100 a share and me make money is to stay with it. Now, because I brought it on the original breakout, down at the $11, $12 range, on it there, I'm still up. I don't have to panic. But at the same time, I got to give it time to work its way up to, if it's going that way, give it a chance. That's the one thing I'm going to say to most of you. You got to be patient with some of these companies. No stock is going to run. Now, somebody's asked me, Bitcoin might be going down that route. What do you think? I am not a cryptocurrency trader. There's no fundamentals in the cryptos for me. If you're trading cryptos, you're basically trading on pure technical analysis. One of two things. Either you're a long-term holder in the cryptos because you believe in it long-term. If you're short-term, you need to have a trader's mentality. All right, that's the way to do it. Now, I know that, let's see if I can pull up the chart. Let's see. Come on, where you at? There you go. No, that's not it. Give me a second. Come on, I want the. I think. No, is that it? Hold on a second. I'll tell you in 1 second. Nope, that's not it. So I don't even know the symbol. But I know one of you guys will tell me. So that just tells you how much I trade Bitcoin. I don't even know the symbol. These are all these different trusts. So anyway, I haven't pulled up the chart. I don't know what the chart is. I don't know what the symbol is. If you know what the symbol is, fine, tell me. But the deal is, I would again apply technical analysis to Bitcoin. There's no fundamentals to any of the cryptos. So I'm told it's BTC. So let's see, BTC. Oh, there it is. Thank you. There's the futures on Bitcoin. I'm going to look at the current month. So I'm in the futures contract right now. I'm looking at the current month. And whoa. This is the Bitcoin futures, huh? Let me switch this to a daily. Excuse me, a weekly. All right. I got to look at this a little more. It looks like the stock that Bitcoin has run. We're at its all-time high. It looks like the breakout came from about 1,200. I'm looking at a weekly, so let me switch it to a daily. Let's see. Oh, yeah. This breakout came at around 1,200. There was some backing and filling consolidation here at 1,400. Then there's some more backing and filling here at 1,600. It looks like the breakout came from 1,600 and ran the way it is. It came back and tested that 1,600 2 to 3 days ago, and then it's back up near the high. Technically, as I tell you guys, I'm not a big trader in terms of buying stocks after the big move. So I'm looking now. The stock is consolidated. The breakout was 1,600 from there. 1,600, 19, 2,000, 20,000. I would look for Bitcoin to do some backing and filling right here. Trade sideways, and then buy it on the next breakout. I wouldn't be aggressively buying it right now. So I would expect, and I'm looking at the chart, I would expect Bitcoin over the next couple of days to back and fill, which it did a little bit, but trade sideways between 20,000 and it looks like about 18.5. So I would expect it to trade in that range, and then on the breakout above the 20,000 after the consolidation, I would look to trade it. So yeah, I mean, and I see that some of you guys are looking to get back in it. That's what you said. So that's what I would do with Bitcoin. All right, now, what was I going to say? I did cash per sleep. I did Uber LYFT. Okay, cool. So again, repeat. I know I'm redundant here, but let me repeat again. Once an IPO starts trading, whether it be the first day, the second day, the third day, the first week, even 2 or 3 weeks later, a month, if it breaks its syndicate bid, it is in trouble. I picked out 4 stocks, names that you know. I could pull up a list of 20 different companies that have gone public, and when they broke that syndicate bid, I'm talking about recently, the stocks have done nothing but go straight down. And in some cases, I was looking at one stock that I thought about putting up, but I just didn't have enough time, or I shouldn't say time. I didn't want to overwhelm you with different charts and companies. But there's one company, was it Luckin Coffee out of China? Stock was priced, I believe, at 10, ran, and then it broke that IPO price of 10 about a month later off of some bad news, and the stock went from 10 down to, I think it's down here. It's actually delisted. Yeah, I'm trying to find this symbol now. It doesn't have the symbol it went public with. It's actually over the counter. It's a bulletin board stock. And right now the stock is trading at $4 a share. And this was after a run up. Understand, priced at 10, opened up at 25, and it's been as high as 27, and again as high as $50 a share. And then all of a sudden it broke. So that's what you're looking at. Now there was some negative news on it, but that's what's going on. And there's a number of companies like this. So one of the things I tell you guys is not all IPOs turn the corner. The majority of IPOs, 75, 80% of them, don't last over 2 years. I did a study recently, and I went back and looked at all the hot IPOs during the dot-com boom. I went back and I looked at all the hot IPOs in 2007, 2008, only to find out that the majority of them are gone. Gone. Either they were acquired at a much lower price or out of business. Gone. So even in some of these were some what we at the time were considered some very hot names. So that's my advice. That's what I'm doing. That's what's going on. All right. Any other questions? I had some other question. I'm trying to think what that other question was. I had a question that someone asked me, and I cannot remember what the question was. I can't remember what the question was. So I guess unless I see some questions coming in, I pretty much have gone through the IPO process on what to do with a what I call a down stock, one that breaks syndicate bid. And again, just to rehash, I do believe that the market's still bullish. I do believe that this pullback is healthy. I do believe that going back sideways and consolidating is healthy for your stocks. If you're a short-term trader, that's what I was going to say. That's what happened. I've had a number of people talk to me about what they call dollar cost averaging. And all that means is when their stock that they like has pulled back, they want to buy more. So here's my comment to you guys. 2 things. One, if you're dollar cost averaging, it needs to be a stock that you plan on holding for the next, 3, 4, 5, 6, 7 years. If you're doing any type of short-term trading, if you're doing any type of short-term trading, you do not want to buy stocks or dollar cost averaging. I said it earlier, so let me say it again. If you're a momentum trader, which most traders tend to be, they add to positions as the stock confirms itself. You don't see momentum traders add to positions as they drop down. All right. And the reason being is neither you nor I know what the bottom is. All right. We don't know what the bottom is. I tell you guys, here's what I think is support, but it could break through support and keep going down. And unless you know where if you don't know where the bottom is, how can you bottom fish and bottom tick a stock? So if you want to improve your performance, when you buy a position and you're using stops or you have a mental stop, if it comes down to here, get out. If it goes back up, you can always get back in. And as it goes up, add to your position. Now, I know you're adding to position, you're raising your average cost, but that's how you start to make money. If you add to losing positions, as they go down, you're trying to pick the bottom. You're trying to time the stock or trying to time the market. I highly don't recommend that. All right. All it takes is for one company that you keep adding to as it goes down, that keeps going down because you're trying to pick the bottom. So with that said, and well, I disagree with that. So if you read the comment, Chantel saying, I brought in too high on Workhorse and I was thinking about buying more while it's lower. How low is it going, Chantel? Is this the low? Is it going lower than this? How low can it go? So what you're doing now is you're committing good money after bad money on a position that you said that you felt that you brought too high. So now you got two choices. One is cut your losses and look to buy it back when it starts to rally again, or sit with what you have, and then when it does rally back, if it does rally back to its old high and through it, to add to it. Again, I don't know the chart, so I'm not looking at that. But again, and my rule of thumb is this, typically 10% below what you purchased. So if you brought the stock at 28, I'd probably have it stopping there around 25, almost 3 points below where it is now. So I'm not sure what to do with it at 20. I don't know the company that well. I don't know what it's trading. But again, if you're going to, I would not add to it, because if you add to it at 20, what you're saying to me is, Professor Milligan, this stock is near its low. I think it's at its low. I'm going to buy it here, and because it's its low, and it's going to turn from here and go up. I've been at this a long, long, long time. I remember the dot-com bubble. All right. Some of you guys on this call might not even know what the stock market was when the dot-com bubble hit in 2000, 2001. And what was interesting about the dot-com bubble when it happened, I can remember going to the gym to work out and people sitting next to me on the stationary bike or working out telling me how much money they made in the stock market, and how even when the stocks that they purchased went down, they would just buy them on the dips because they always rallied back. And my comment to them was, what if they don't rally back? You said they always rally back. What if they don't? No, you don't understand. They always rally back. And I'm like, they always don't rally back. You happen to be in what we call a raging bull market, which is pulling everything up. A raging bull market is like a high tide. It lifts all boats. So they kept telling me, no, you don't understand, Mike. I'm buying on the dips. It always rallies back. Those same people, several weeks later, I'll never invest in the stock market ever again. I lost all my money. I lost all my profit. And I said to him, you don't add to losing positions. Just get that out of your head. You don't add, if stock's going down, don't add to it. Add to it when it's going up. Unless you're a long-term holder. If you're a trader, great. If you're a long-term holder, great. Add to it. There's some stocks in the portfolio I have. I don't plan on selling for a while. I mean, they literally have to physically break down. Them coming down with this market and so forth doesn't faze me. I'm a long-term holder because they haven't given me any reason to actually get out of them. My short-term stuff, I was into one of the electronic auto Chinese stocks, the LI. I was in there, brought it, it ran, had a couple of points in there, it didn't hold, it pulled back, I got out. It was a trading idea, short-term trade, in, out, gone. All right, I think I ended up with like $1 profit, took that little $1 profit, went about my business. So you have to decide what it is you're doing with this stock, Chantel. Are you going to be a long-term investor? Or are you short-term trading? If you were short-term trading, you should have been out at 25 and then revisited again at 28. If you're a long-term investor, sure, you can add to it at 20. Just understand what you're saying is you hope that this, and I said the right word, you're hoping that the stock rallies back to where it was. All right. So hopefully that gives you guys some insights. All right. Now, any other questions coming forward? By the way, I love talking about this stuff. And don't get me wrong, guys. I'm not 100%. I don't make, I lose money like you do. I just told you guys I'm down 7% in my portfolio today. My trading account's down 7% today. All right. Net is still up for the, for the year. Net is still up for the month. But I took a hit today. All right. And it's okay. Because I like the positions I'm in. The only one, I take that back. The only one I got to review now is because of what's happening with the earnings is Snowflake. And I knew earnings were coming, and I'm surprised, I really am surprised that they missed the number the way they did. Not that they missed the number, that Wall Street dismissed it in terms of expectations. The thing that you got to understand is that these investment bankers know the company. They know what's going on with the numbers. The numbers are already in the books. So they have a good idea what the quarter is going to be. They have a good idea what the year-end number is going to be. The investment bankers do. And I'm surprised that the stock has come off like it did based on the fact that they pretty much already know what the numbers are. Do I consider gold as a groundless or baseless I'm not sure what BTC means. Again, I apologize. You guys have, you're a younger generation. You have abbreviations for stuff, and I'm not sure. Oh, as Bitcoin. So do I consider gold groundless and baseless as Bitcoin? I'm not a big fan of gold. It's just that simple. Just not. The reason being is gold is a precious metal. It's not an industrial metal. It's based on supply and demand by people's interest in owning gold or having gold. It's typically and what they call an inflation hedge. But I'm not a big fan of gold. Just not. If I was, I could see trading gold, but I'd stay away from it. That's just me. Don't get me wrong. I've traded gold futures in the past, but in terms of investing or trading, I'm not a big fan of gold. It just doesn't, I think there are other things out there that you can look at that can give you the same upside potential or even more upside potential. Gold falls into the bigger fool theory. Gold generates no revenue. Gold generates no cash flow. In fact, it costs money to actually store gold. So you actually store gold. So what's going to make the price of gold go up? The only thing that makes the price of gold go up is that somebody else in the marketplace wants to pay you more for what you paid for it. There's nothing really driving it. And again, don't get me wrong, there's the gold bugs, the gold, we would call them gold bugs. They have the fear of the economy, a fear of the marketplace going to zero, fear of the apocalypse that's going to happen, gloom and doom, and the best place to go is have it in gold. So if you need to hedge something, I'd hedge it with gold, but I wouldn't use gold as my main trading vehicle if I was a trader. That's just, again, my opinion from what I've seen over the years. And Bitcoin falls into the same boat. It really does. I've asked a number of people, and I'm not ashamed to say it. I asked a number of people to explain to me the fundamentals behind Bitcoin. And all they keep telling me is, well, you mine it and this and that. And I'm saying, okay, great, but you still haven't told me what's the fundamentals behind it. I can give you the fundamentals behind the US dollar. I can tell you why the US dollar is going to go up or go down based on fundamentals. And if the short answer is, the dollar has a correlation between our economy and has a inverse correlation to inflation. So we can kind of understand what's going on. The other thing that happens too is, even though our economy might not be doing the best, another thing that actually helps our dollar is it's the safest currency in the world. So as other countries go into financial difficulty, they're going to actually invest in the dollar. So I can understand and I can get behind why the dollar is going to move up or move down fundamentally as well as technically. I can't get behind the Bitcoin or gold, other than gold with the economy. So that's just my belief. I truly believe that for the average investor, turn this thing down. I truly believe for the average investor that they should spend more time focusing on corporations and companies that are doing well than trying to time the market in terms of inflation and so forth, recession, trying to time the market. I think the average investor should focus on the stock market or stocks per se. I also believe that the average investor should couple together both technical and fundamental analysis. I think that both go together. Now, some of you short-term traders, and again, I cut my teeth on short-term trading. I wasn't a day trader, but I might be in a stock for a day. I might be in it for a week or 2 weeks. But when I first started, I wasn't in a stock longer than maybe a couple of weeks at the most. So what I'm saying to you is, I think you should focus on fundamentals and technicals of a stock. Even when I was short-term trading, the stocks that seemed to do the best long-term had the fundamentals behind it as well as the technicals. All right? That's what I really look for. I want companies that have both the fundamentals behind it and the technicals. You show me a stock that has great fundamentals and no technicals, I'm like, no interest. You show me a stock that has great technicals and no fundamentals, I might trade it. But again, It's not high on my priority list. I want the best of breed. I want the best company in the best sector with the best looking technical chart with the best fundamentals. That's who I want to own. That's who I want to trade. When this market does get hammered, and eventually all markets do get hammered, who do you think is going to get hammered less? A great solid fundamental company or something that just ran up because of technicals with no fundamentals behind it? Who's going to get hammered the most? You already know the answer. So one of the ways that you can protect your assets, one of the ways you can protect your portfolio is by having quality companies in there that won't take the hit that the other ones. Now, they're going to take a hit, don't get me wrong, but the hit won't be as bad. Think about it. Go back and look at some of the trades. Look at some of the trades you've done. Look at the market. That's how it works. So someone's asking, what are the main fundamentals or technicals I should look for? So here's what I look for. I look for revenue growth. I look for earnings growth. Those are the two that I look at. There's no problem with it. I look at revenue growth. I look at earnings growth. I also look at the sector they're in, the industry. I want to look and see if they're the only ones with great numbers or the whole industry's having good numbers. I'd rather have a whole industry with great numbers. I don't want the outlier. I don't want the one company that's doing great in the sector and everyone else is doing horrible. I want to go into the sector because that means money's flowing into that sector. So I want the best company in the best sector. All right. So I want the best. I want to trade those. The other thing I'm going to say to you is this: when it comes to trading these things, I'm trying to figure out how to phrase this. When it comes to trading these things, you want the best of breed. Doesn't mean that, how can I put this? It doesn't mean that it's going to work out for you, but that's what you want to look at. The other thing I look at when it comes to fundamentals is, and I talked about this before, I have my 6 criteria that I use when I look at companies. And one of the 6 criteria that I look at is I want to look and see what the catalyst, and I know I said this before and I'm going to say it again, what's going to drive the value in this business? What's going to drive it? So I'll give you a case in point. The coronavirus basically has driven Zoom, Peloton. That's the catalyst that drove them. Netflix, because people were working from home. That was the catalyst that drove them. Several years back, I'm just trying to pick out some obvious things. Several years back, the airline stocks all took off. They exploded. Why? Easy. Oil prices went from $150 a barrel down to $100 a barrel. They actually dropped down to $30 a barrel at one point. Jet fuel prices dropped. It improved the profit margins for airline stocks, and they all took off. That drop in oil price was the catalyst that drove the airline industry. One of the things you're reading now is what? You're reading that it's hard to find housing. It's hard to find housing now. To buy a house, there's a low supply and there's a high demand for 2 reasons. 1, more people are working from home. And 2, we have the lowest interest rates we've ever had. That's driving the real estate market. That's a catalyst. So one of the things that you want to look at is when you start looking at these companies, say, what's going to drive the value up? What's going to drive it? Bitcoin and gold's being driven by supply and demand. But what's really driving it? What's going to drive these companies up? Ask yourself that. Now, Amazon, I haven't looked at the numbers. They talked about Black Friday with the whole, buying of goods and services for Christmas. I haven't looked at Amazon's numbers, but if anything, Amazon's numbers have to be up because so many people are actually buying online now. They're not even going into the stores. That's a catalyst that's going to drive Amazon. When you start looking at these companies, ask yourself, what's going to drive the value? What's going to drive the growth? Now, let's see. Somebody says here, I just started trading 2 months back. What is a respectable profit margin? I've gotten 34 so far from my put spread. Might just be lucky. I started during a raging bull market. So based on what you're telling me, I imagine you're talking about your trading options. And you're asking me what's a good profit margin. You ready for this? My goal when I started trading was to print black ink every time I traded. That was my goal. I didn't worry about how much money I was making. I just wanted to print black ink. Then after I started learning how to print black ink, not red ink yet, red ink's a loss. After I learned how to print black ink, the next thing I did was I set a dollar amount of how much I wanted to make per day. Just that quick. And eventually at one point, my goal had got up to $1,000 a day. Some days I got it, some days I didn't, some days I got a lot more than $1,000. But those were daily goals that I set for myself when I was actually actively trading. And the reason why I set those goals is that I wasn't trying to hit a home run every time. I was just trying to get on base. I knew if I got on base enough, eventually I'd get to second base, maybe I'd even get to third base. Every now and then I might even get a home run. But Rod Carew, the great Rod Carew, one of the greatest hitters in baseball history, was not a home run hitter. You just could not strike the guy out. And he's in the Hall of Fame because you could not strike the guy out. I wanted to be Rod Carew. And when it came to trading, I did not want to strike out. Question is, how long do you think it will take airline stocks to rebound? I don't know. And I'm not trying to be funny. I'll look at the airline stocks once they start to go back near their old high. Now, here's what's interesting. JetBlue just did a huge secondary today. And the stock is actually, I'm going, bear with me. I got a couple minutes here before this thing shuts off on me, so I can't stay on long. I'm pulling up JetBlue. So JetBlue, if I remember correctly, I think the deal was priced at 14. I can look it up, but I don't want to break away to look. Stock ran today. Stock closed, looks like closed at $14.97. And it was a huge offering, secondary offering. So why did it run? It's easy. What's happening now is the market's forward looking. We're looking 6 months to a year out. Looking a year out, whether you agree with it or not, Wall Street's starting to say, look, this pandemic might be over. We've got vaccinations now. They're going to start being shipped. You're hearing that they believe that by June of 2021, all of these companies now, by June of 2021, they're saying that most Americans could actually be vaccinated. Most of the world could be vaccinated by that. They're putting a push on it. And so you're starting to see them saying, hey, maybe there's a rebound. So that's why you're seeing this. Remember, the market is forward looking. They don't look at what happened today, or they look at what they believe is going to happen going forward. So you want to be forward looking too. All right. Boeing's treating you real nice. Yeah, Boeing's a good buy. Boeing's not going out of business. It's a long-term hold. If I were you, I wouldn't be trading. I'd just buy it and throw it in the corner and just hold it. Reason being is Boeing's not going out of business because it's the only airline manufacturer here in the U.S. The United States government will not let Boeing go out of business. They cannot afford to let Boeing go out of business. If Boeing goes out of business, it means that all major aircrafts are going to be built in Europe with Airbus. It's a great long-term safe bet. Is there going to be some volatility? Answer is yes. There's going to be some tremendous volatility in there. But long-term view, you're going to be fine. Boeing's going to work its problems out in the U.S. government and the Wall Street. Everyone wants them to work out these problems. We need them to work out their problems. If I remember correctly, I think Boeing is either the second or third largest employee in the country in terms of corporate America. So they, as the saying goes, and you've heard it before, too big to fail. All right, let's see. I got another question. So question was, can we be moving out of COVID in the next couple of months? And the short answer is, yeah, we actually could be moving out of COVID. The market's looking at that now. The market's starting to say, okay, we got the vaccine. Things could be actually moving back to normal, or the new normal, quote unquote, as they say. So yeah, that's what, again, I apologize for that. Forward looking, guys. The market is forward looking. You must be forward looking. Don't worry about what happened 2 days ago. Worry about what in terms of your investments, look at what you think a forecast is going to happen going forward. The analogy that someone said to me once, I said, that's a great analogy. When you drive down the highway in your car, you got two eyes looking forward, and every now and then you glance in your side and rear view mirror to see what's coming up behind you. But most of your focus is where? In front of you, looking down the road. And you're not looking at just the car in front of you. You're looking down the highway because you're saying, hey, if there's a roadblock or accident, I'm going to get off this exit before I get to it. That's the way we have to be. That's who we are. We're forward looking. And if you're forward looking and things start to change, you say, whoa, there's a roadblock up there, I'm gonna get off, you sell the stock. But if everything's going the way you project and you're looking, you keep looking down that road, you're gonna stay with the stock. And that's how you're gonna make your money. Again, I can't emphasize this enough. Do not get caught in these short-term trading trends and say, oh, the market's been down for the last 3 or 4 days, it's time to get out. Understand, just last week we went to an all-time high, 30,000. You want the market to pull back and catch its breath. The market just ran a marathon. It ran a marathon. It's going to pull back and catch its breath. And the other thing that you got to understand too is, I'm looking at my time, I got to say this real quick and then get out of here. Institutional investors near year end do what they call window dressing. Window dressing, profit taking, there's a whole bunch going on with institutional investors going into the last month of the year. All right? They have certain things they want to have in their portfolio. There's certain things they don't want to have in their portfolio. There's certain things they want to take the tax loss on. So they're going to sell it, maybe buy it back in January because of the wash sale. If you don't know what I'm talking about, it's okay. But portfolio managers like now do certain things to dress up their portfolio for year end. Some of them are locking in profits so they can actually pay it to clients. There's a whole lot of things going on in the market this last month that you normally don't see. And the other thing you'll see is you're going to see this market move up or down. You're going to see your stocks move up or down off of very little volume at times. All right, I got to hop because I want to save this and post it. Thanks for guys showing up. Again, I'm going to post this. I do appreciate you. And again, as you guys start to make money and do make money, please feel free to share it with everyone else on here, what you're doing, what your strategy is. I have a couple of strategies, but by no means do I have a claim to have all the different strategies out there. So again, thank you for coming to Wall Street Wednesday, and I will see you next Wednesday. Let's go make some money, guys. Have a blessed one.